Hi, and welcome back. Our topic for now will be IRS employment tax issues. Now, we will encounter two types of the employment issues. To begin with, many businesses will treat employees as contract labor because they don't want to withhold taxes, they don't want to get involved with payroll, they don't want to match the Social Security portion and the Medicare. If you remember, or if you do accounting for your business, or if you're representing your client, there's two portions. To begin with, an employee will fill out a Form W-4, and based upon the exemptions claimed, the employer will withhold federal income tax, state income tax. Then we have Social Security and the Medicare, which is 7.65% on the employee, 7.65% on the employer. So they don't want to mess with that, and they figure, hey, just pay them straight out, and therefore we don't need to worry about all this. And it's very common in the contracting industry specifically. So let's go ahead and discuss treating employees as contract labor to begin with, and then we'll get into the trust fund penalty portion for corporate officers who are held responsible for taxes withheld. Treating employees as contract labor, please read through the page, and it discusses the 20 common law factors. Read through them, but in a nutshell, if you're an employer and you tell an individual what time to come to work, what time to leave, you give them training, you have set hours of operations, full-time is required. I mean, come on, folks. This individual is definitely an employee. So what happens here, if most of the time an office examiner does not get involved in changing classifications of a contract labor to an employee, usually revenue agents will do that. There's two code sections, just to let you know in a nutshell. Code section, Internal Revenue Code section 3509A and 3509B. So when they switch from a contractor, subcontractor, to an employee, the business is liable, works out to be approximately 11%, because what they do is they will hold them liable for about 3% FIT, federal income tax, and then you have your Medicare and your Social Security, which equals to the 7.65%. And then they accumulate that, and they will assess the individual. And it could be very, very, very high, because, for example, when I used to be an IRS agent, we used to audit the garment industry. And many of your manufacturers, they have cutters, which cut the fabric, and then you have the sewers that will sew. They will pay them cash, just as contract labor. And some of these wages issued, or wages that should have been declared as wages, are in the millions each year. So when you take 11% and you have 2-3 years, because now they will file 941s for each year missed, and the annual 940 plus the interest excuse me, and the penalties, it could amount to a few hundreds of thousands of dollars. So just keep that in mind. And read through the 20 common law factors here. And if you have any questions, please visit our community for more discussion on the subject, or if you're stuck somewhere where you need some clarification on. The second portion, which is really, it does get a little bit extensive. It's called trust fund recovery penalty, and I'm going to simplify it for you. If I am an officer of a corporation, and the corporation withheld federal income taxes, Social Security, and the Medicare portion from the employee, and rather than submitting those payments to the IRS on behalf of the employee, as well as the matching, the 7.65% matching by the company, we spent it. We paid bills with it. The business is not doing well, or we spent it on luxury items, saying, oh, it's okay, I'll make money next month, I'll pay the IRS. So what happens there is the IRS, when they are looking for this money, they will look at the individual who is responsible for this, and I do have a clickable link for you here to where you can actually print form 4180. So please do print that form and pause the tape a little bit so you can see what it's all about, if you haven't done so yet. A revenue officer from the collection division is the individual who usually gets involved. They will take this report. They'll find out who are the who is the president, the VP, officers of the company, and so forth. They will conduct an interview, and if you had any authority whatsoever, such as determining or stating what checks who and who does not get paid, you sign the checks, you have managerial authority, you could be held liable under the trust fund penalty. How does it work? The IRS is not interested in the portion that the company matches, the 7.65%, but they are interested in the money withheld from the employee. So if the company is defunct, meaning that it's out of business or bankrupt, when you do the interview, at least you can reduce the liability owed to the IRS by the 7.65% of the total wage paid during the year or maybe several years that this has been taking place. Once this is assessed, there's two solutions. The first one is, now we know how much we owe, so we can establish a payment plan. And the other solution is to do an offer and compromise. If you want to establish a payment plan, please review the collection section of our tapes. Do an offer and compromise. Please review the offer and compromise section. And that's the only alternative we have, unless, and again, if this individual has assets such as major equities in a home, the IRS wants that equity, because this is one area that the IRS dislikes when there are trust fund penalties imposed on an individual. They want their money right away, and they take it very seriously. So I hope you enjoyed this. And there's another element too I would like to mention before I close off, and that is, when you have contract labor that are working and you need to issue 1099s, and 1099s are not issued, the penalty there is $50 per 1099 that is not issued. Anyway, if you have any questions about the topic, please go ahead and join our community, ask your questions. We're here to help. And thank you for watching.